Ladies and gentlemen, good day and welcome to ABB India Limited Q3 July to September quarter CY 2025 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that the conference is being recorded, and any unauthorized recording of this call is strictly prohibited. The recording will be made available on the company's and SEBI's website subsequently. I now hand the conference over to Mr. T.K. Sridhar, Chief Financial Officer of ABB India Limited. Thank you, and over to you, Mr. T.K. Sridhar.
Good morning, very good morning. Thank you very much for conducting the first few words about it. So, ladies and gentlemen, welcome, very good morning once again. Welcome to the Q3 2025 investor call of ABB India Limited. So, on the call, along with me are Sanjeev Sharma, the Country Managing Director of ABB India. I have Kiran Dutt, who leads electrification business in India, and also Sanjeev Arora, who leads the motion business, and Subrata Karmarkar for the robotics. Unfortunately, Balaji, who leads the PA and Process Automation Division, is not able to join because of his customer commitments. So with this, I hand over the call to Sanjeev to take us through the initial macro and the market slides of ABB. So over to you, Sanjeev.
Thank you, Sridhar, and good morning to all of you. Happy to welcome all of you to this our quarter three performance session. So I'll give you some business highlights followed by financial highlights by T.K. Sridhar, and then we'll have a question and answer session. Next slide, please. So if you see the business highlights, so we had a 13% base order growth and 14% revenue growth. But if you compare last year, in this quarter we had some large contracts, large orders. So if you look into the overall order growth, that looks -3%, but the base order growth was quite healthy. Profitability is 16% up quarter on quarter, and it is -7% year on year profit after tax. And there are mixed issues, I think, which we'll take up in the financial presentation. We'll give you more details then. And we continue to maintain a strong cash position, nearly 5,000 crores. We continue to expand our portfolio and bring more premium products to the market because market is demanding it. And we have introduced IE5 ultra premium efficiency LV motors, and this is proven induction motor technology and free from rare earth materials. We also successfully commissioned some ABB Ability SCADA Advantage solution for Think Gas Private Limited, enabling end-to-end automation and digitalization for compressed gas distribution network. Sustainability is on target, and I'll give you more data. And all our motion factories are certified as zero waste to landfill as on date. Next slide, please. So we saw a good revenue growth of +14%, and as I said, net of large orders, we had -3% orders growth, +13% in the base orders. And our order backlog stands at 9,895 crores, gives us a good visibility of revenues in the coming quarters. Renewables, buildings and infrastructure, discrete automation, process industries, I think these are the themes which are built around the opportunities we saw in the marketplace. Next slide, please. So you can see that the diversity of our portfolio plays in diversity of applications, right from wind turbine converters to gas chromatographs, oxygen analyzer for a leading integrated energy player, electrical instrumentation for global F&B player, robotic solution for EV mobility, insulated case circuit breakers for power distribution equipment company, process automation and drive solution for Meta. So we can see our 18 businesses playing this 23 market segment always keeps the robustness of the business model at the company level. Next, please. The key element of our expansion of our business is to continue to expand into new market segments, also new geographies, and also keep introducing and reintroducing our technologies to our partners and customers. And our team does customer connect programs across the width and the depth of country in the market segments as well as geographies, and customer large and the medium and the small size customer base, and that's something that keeps us growth initiatives and the growth impulse that we need inside the company, and that has been the drumbeat for last many years, and our team continue to have that drumbeat going. Next, please. Our focus on diverse business market segments, which is spread in 23 market segments. We continue to see high engagement and high response in data center, electronics, and renewable. And our portfolio is, resonating well in these, and these are the long-term gains. And I think we see a much more capacity build-up coming in these areas in near future. And the moderate growth is basically the segments in the middle, and the low growth segment that we see at this point of time, which continue to rotate over a period of time, are listed on the right column. Next, please. So theme for the quarter is giving an idea about textiles, a deep dive. India is the world's second largest producer of textile garments with 4.6% share of global trade. It is expected that it will grow at 8.6% CAGR. And the competitive advantage of India into this sector is availability of raw material and also skilled manpower at competitive cost, which is a driving element for this business to happen. And government is paying attention and has some good initiatives in this area, including the PLI scheme and GST rationalization to boost domestic demand. And also there are key trends which are right now affecting. I think there is a bit of a challenge for this sector with the U.S. tariff impact, but at the same time, India is diversifying itself and creating more partner countries to mitigate those tariff impact. Infrastructure is being modernized, and also more sustainable manufacturing practices are being brought in this area. And ABB offers motors, drives, PLCs, engineering tools, service and support, and host of other solutions in this particular market segment. So we always make sure that we have good proposition for this growing and important segment in the country. Next, please. On the sustainability in practice, we are on track. Our target for reducing the GHG emission was 87%. We have achieved it at 87.05. Zero waste to landfill units. We had target that in 2025, 4 units will be zero waste to landfill. We have achieved 4. So great job done by our team and locations. And also we focus on that our units will turn water positive unit. That is, we put more water in the ground than we take it out. And our target is 4 units. We have already achieved 3. And one unit remaining is under certification at the moment. Most likely by end of the year we will achieve the target. And water recyclability is at 44%, and our target is 50% for this year. Next, please. On the CSR and performance with purpose, we continue to focus on education and skilling, diversity and inclusion, communities and environment. And for last 10 years, we always spend 100% of CSR allocation. And now having run these programs for a period of time, we can really see visible impact wherever we have engaged. And we do it in a very institutionalized way, and our teams can see the impact on the communities and the targeted programs that we have taken. Next, please. For 2025 outlook, I think tailwinds are private consumption, government capital expenditure, and moderating inflation. But headwinds, as we know, trade uncertainty is playing out around India. We have prolonged geopolitical tensions which haven't found a way to subside, but I think we'll have to see that through. And of course, there's a volatility in the global financial markets, and there's a lot of fluctuation on the forex. So these are the things we need to navigate, both on the opportunity side and the challenges side as we finish 2025 in 1.5 months and then also enter 2026. Next slide, please. So here I hand it back to T.K. Sridhar to take you through financial highlights. Over to you, Sridhar.
Thank you, Sanjeev. So I think we now get into the most meaty part of it, which is the numbers, where I think people are waiting for more information sharing. So I think if you look at these set of numbers which is there on the slide, so the orders, base orders, which we call have an execution cycle which is shorter compared to the larger orders, which more represent the project orders or the long-term system orders. So we have grown for the quarter a 13% growth, which is as per what we understand with the market dynamics which is there. This is pretty healthy stuff, at least because it gives us the visibility of revenue conversions going forward, just not depending on the large orders which are there in the backlogs at this point of time. So, and this is spread across all the business divisions in the respective business segments. So it's not just in one division which has really helped us to do it, but it is across. So it's I would say, a good recovery which has happened from the previous quarter, where we could see certain offshoots which are coming up. So that's about the orders. And when we come to the backlogs, 9,900 crores of backlog roughly on the books. And this would be definitely be executed over the next quarters. We do have a plan, and there are no slow-moving or long-term orders, slow-moving or non-moving orders. Everything are lined up for execution in the few quarters to come. And also this has almost 30% of it as a composition of large orders. So it is basically 70%, which are the smaller orders which will get executed on a month-to-month basis. Revenues, because we have a backlog and we said that we would be definitely be executing it, so it has generated the 14% growth. And profitability, we are at 16.4 on PBT, compared to sequentially 14.9, but compared to the previous year of 20.5. We will dwell upon this as we go forward. And that's more due to the material cost impact. We have a mix issue of revenue which we are having because we are definitely pushing the new technologies around, and also forex, which Sanjeev alluded to in his section, and also last but not the least, the very recent impact of QCO or the BIS certification, which is needed for the locally manufactured products to be used in the production. Right. So this is basically the overview of how we are for the quarter. And the cash balance, 4,500 crores. Of course, we could have done slightly better over here. Now, we have stocked up strategically inventories to make sure that we are not bound by any QCO obligations which could come up a surprise or a delay in certification. So we need to serve our customers because we have committed delivery lines for the backlogs, and we have done a conscious strategic stocking up over there on the inventories, which I'm pretty much sure will get liquidated as we go into 2026. The next slide. So this gives a bit of a more granular view of the P&L. If you look at it, of revenues we did discuss, and then we come to material cost. So material cost is something which I know that people are looking at as to what could be the increase in the material costs. And I think it's better that we go business area by business area so that you have a bit of more granularity on it. So overall, if we see, it's an issue of mix of revenues, the portfolio changes which has happened, and also on the competition which has intensified in quite a few segments, and also the fact that we had an ability to command a premium in the post-COVID era, which has now sort of dried up. So that's something which is not now there, and also under the market dynamics which are slowing down the decision on quite a few orders, and therefore opportunities are restricted in the market to play with. And last but not the least, we have the QCO impact as well. So that's how it is. But other expenses, if you look, they are more or less steady. No one-offs as what I would see in the expenses if you see that. And unlike the last quarter, we did not have any big forex impact in this particular quarter. But I think the rest of it is basically mathematical calculation. So I think so this is how we have an overall P&L structure for this. So if you go to the next slide. So electrification. I think on the electrification, in the Q3 2024, we had almost 560 crores of a large order, right, which is not there in this particular quarter. So that means against 1,700, 1,800 if we round it off, if you take off 600, so then we're talking of 1,200 crores. So I think the base orders have still grown in EL electrification. So that's something which is important to note, and we have been consistent in that particular effort. So the revenues, I think it is across all divisions. There have been no division which is finding it difficult to execute the backlog and the revenues. The backlogs definitely is down 2%. It's more related to the pace of execution is faster than the pace of intake of orders, and that's therefore it's a reflection of that. But I'm sure that as the market picks up and we are able to be successful, we should be able to also line up the backlogs going forward. So now comes the profitability element. So I think there were a bit of a questions as to what is the impact which is playing out in electrification. So just to give you a bit of a picture on it, I think both MO and EL have similar issues. Okay, so they have issue of mix, which is basically what we do, which is a reflection of both market segments where we play out, and also the portfolio what we have used to deliver the solutions to the customers. Right? I think that's how we see the mix. So that means if an high profitability segment is absent in this particular or lower in this quarter, but we have gone, because I take you back to those slides where we used to say what are the high growth markets, the moderate and the low growth market, and naturally the competition also plays out accordingly in these particular segments, and that has a reflection on the mix topic as what we see. So the mix is one thing, and then of course the competition as what we see in the limited opportunities what we have at this point of time, which has also got an impact on how the pricing is done, and followed by the QCO and the forex impact. So now just to call out some of to draw a bit of a color, what's the mix impact in electrification? Probably up 1% could be the mix impact which we have, because that's the portfolio changes what has happened, that's the market segment changes what has happened where we have delivered these particular revenues. And competition, clearly I think as I said in the past, we had a clear advantage of 1 to 1.5% in which we used to claim a price premium, which is not there at this point of time. And QCO impact, it depends on business to business, ranging between 0.75 to 0.8 sort of a percentage is what we have, and forex 0.6%. So roughly this works out to a gap of 3% on an average, which used to be the trend earlier in EL in the last 3 quarters as what we have seen, right? So if you look at it, a gap of this is contributing to that. Right, and so that's how I see EL thing. But I think all these are they something not normal? According to me, we have gone through these particular cycles. Cycles at this point of time are softening, as what we see, and therefore we play out. We continue our investments as what is needed for the future. We see that the opportunities are there. They are something which are not drying up at this point of time, but of course the decisions are delayed, and also we make sure that we pick those opportunities which are relevant for our portfolio and good to play, good to participate in. So that's basically an approach what ABB has, and that has been consistent even in the past. If we go to the next. Motion, right? So motion again. I think we had a good order of a good order intake in this particular quarter. Of course, we had a large order which played out in motion to the extent of 150 crores, which was not there. And to the extent of 900 crores was what was there. 990 crores which was there in the last quarter, the similar year. So again, a good base order growth. So motors having good base order growth is actually an bit of an what you call a refreshing sign, because that's the early trends which pick up to see that how the market is behaving, and so that's how we do it. So execution 9%, as you know, as I was alluding to, a lot of system orders and large orders which are also sitting as a part of the motion backlogs, and that's why you could see at 4,100 the backlogs which are there, and they have probably a higher content of large system orders and long-term orders which will get executed over a period of 12 to 18 months. That's what we see. So now coming to profitability, we did talk about it in the electrification. So here I think the mix is again 1 to 1.5% which plays out, and then we have the market dynamics and the competition is more intense in terms of degree over here, and that's how we see, because motion has a larger play in core sectors as well as the middle sector as what we used to see. So and therefore, and that's where the competition is intense, and then they have a higher impact in terms of competition dynamics. And they also have a bit of a QCO impact and of course Forex impact, because they have a huge content of Forex which is there. So overall, I think 4.5 to 5% variation in motion compared to the previous profitability levels, and what is now can be attributed to QCO and Forex impact to extent of 1.5%, and then you have the market dynamics and the mix playing out on the rest, which is more market-led topics as what we see. If we go to the next. So now the question could be, so is this QCO impact going to remain for some time? Answer to that is yes, because the dates are definitely changing. So we are preparing ourselves to make sure that we get our slots, get our preparation done for navigating this particular challenge, and every business have an action plan. And I'm sure that will also, I mean, it will take some time, probably another 2 to 3 quarters minimum, which would take this particular issue to be resolved, or for at least for ABB as what we see. So what is this really a QCO impact? I think this was a question which had come to us. I think we normally been using our locally designed products to serve the customers, but as they have to go for approvals and they have to wait for the process to be completed, so naturally, so then we need to definitely use imported equipment to serve the customers, and therefore that's causing a cost which is higher when you import, and definitely a Forex volatility which is impacted to the imported denominated currencies, right? So these are a couple of these things. So can we come out of this faster? Yeah, our efforts are there, so we need to make sure that we are able to work on this consistently in a focused manner. So the next coming to PA, I think PA was pretty interesting. So they are cyclical in nature because they operate more on the core sectors of metals, mining, and oil and gas, and a little bit on pharma side of it. So they see that the order intake stagnant because the decisions especially on larger expansions, are getting delayed, and they are more relying on retrofits and sort of smaller size orders, and they don't have any large orders at this point of time. And that's basically why their revenue levels are also sort of stagnant at 600 crores, and they have a backlog which is falling down because the revenue is coming out of these particular exhausting the backlogs. Profitability is pretty much consistent. They don't have a QCO impact. They are systems businesses, so they have multiple vendors through whom they could source the material, so they relatively are less impacted by the QCO impact. But for the forex impact, because they are long-term contracts, they have forex variation clauses, and therefore they are not much impacted on it. But they have, because they are long-term contracts, the probability to have improvements on the designs, on the optimization of the processes is better, yielding them, and also they have a higher content of services to the extent of 30% in their offerings, and therefore they have a better ability to maintain the margins as what we have seen in the past. Robotics, I think this robotics, definitely ABB globally announced the divestment of robotics, so we still have the decision in India is fully dependent on the board's evaluation and the next set of processes which would happen, which is at this point of time not decided. So they did have a good order intake in this particular quarter to 203 crores, and so that's something, and that had come from their segments which they play out in automotive and electronics area and general industry. So that's how it is. Backlog stronger. Profitability again, so I think it also depends here more on the mix and a bit of a forex. They don't have much of QCO impact over here, so that's how, and they had a bit of a lower service revenues in the last 2 quarters, and therefore the profitability is muted as we stand, right? So this is basically how the segments perform, and then finally we go to the chart which looks at the channels of to the market. If you look at it again, we have a similar ratio of this thing of nothing much changed compared to the previous years, but only thing to note on a cumulative 9-month basis, the service the projects has basically come down to 8%. We have services at 13% and products still at 79%. So I think the ratios more or less remain the same, not much of a change as what we see. So yeah, that's probably last slide. Yeah, I think this is the commentary from the finance side, and so we are exactly 30 minutes from when we started, so we have the next 30 minutes for Q&A. I think we can now open the call for the Q&A topic.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Sumit Kishore with Axis Capital. Please go ahead.
Thanks for the opportunity. My first question is in relation to your margins. Your profit margins for the quarter are closer to the lower end of the wide band of 12 to 15% that you wish to operate in. Qualitatively, if you could elaborate, whether margin pressures around material cost, the market dynamics, post-COVID correction are all factored in, or we still have some room to go. Can this be the new normal for profitability in coming quarters after the record highs that we saw in the last calendar year? So your comments here will be very useful. That's my first question.
Sumit, Sanjeev, I'll take this question, okay. Sumit, I think I had definitely elaborated more than adequately on the profitability movement segment by segment at an overall level, right?
Yes.
So I think that's already answered, so I don't want to repeat it again because that's the thing. So now question is, and as rightly even in the last calls which we had said, so we are at the lower end of the percentages what we want to operate in, and we're doing it at a pretty high levels of 15%. That probably registered in the mind as a new normal for quite a few the markets, But I think we are at the end of the day an engineering industry, and so we have our cyclical impacts to be handled. So now coming back to what are the topics, I don't think we don't have any one-off topics other than what we told about the mix, the market dynamics as what we understand, which more related to the competition scenario playing out on the limited investment decisions what we have, and of course the forex and the QCO. So I don't have anything much more than that. And when will we improve or move forward as in this particular journey? Probably I think the QCO should be addressed in another 3 to 4 quarters as what we see, because that's the timeline what the government has also given, and therefore I should assume that that is what the time with everyone industry will take. That's how it is. And the balance part of it is dependent on how the market develops and how the private consumption and the investment decisions on the public sector happen. So that's how we see. And just to give a bit of more color to our answer on this, do we find opportunities dying out at this point of time? No. Yes, the opportunities are there, but the decisions are delayed, and the choice of customers today are quite variant. And only thing, a factor which we need to probably unknown at this point of time on account of geopolitical topics between India and China, how does it play out is what we need to see, right? So that's something which is unknown at this point of time and left to the best guess of you guys.
Sure. So in the backdrop of what you said and what Sanjeev mentioned on the call earlier, base orders are higher, up 13% year on year. They are stable quarter on quarter. So, is it right for us to sort of interpret that given the decision making is a bit deferred in the backdrop of the macro environment, geopolitical tensions, is this level of base orders, absolute terms, likely to persist for some time before we see a breakout because of a more diversified CapEx cycle playing out? So across your 3 segments, the main ones, electrification, motion, and process automation, how should we think about where we are in the CapEx cycle and how this can play out over the next 12 to 18 months?
Okay. So, Sanjeev, would you like to take up the answer?
Yeah. So we have had a very good cycle post-COVID, wherein we enjoyed very good growth, both in expansion of orders, revenues, profitability, and all elements. And that was on back of India growth story as well as a lot of capex put in by the government in the right places. And also we had a good support in our segments that we were focusing, the new segments, mid segments, and also large core segments. So at this point of time, for last few quarters, now there's a sluggishness in the market in terms of capex formation as well as expansion projects. They are good they're at a good level, but they are not in a very strong expansionary mode. So from our perspective, this is a cycle which comes as a correction after a strong growth. Whether it takes 1 quarter, 2 quarters, our perspective is this is going to come back, the growth is going to come back, and we will ride that cycle because our 18 divisions focus on these very dynamic 23 market segments. The moment the order intake and the order formation takes place, it will directly reflect in our books, in the orders, revenues, as well as in the capacity utilization, which directly impacts the profitability as well. Yeah.
Thank you so much.
Thank you, Kishore.
Thank you. Next question comes from the line of Renu Baid with IIFL Capital, and will advise every participant to stick to one question. Thank you.
Sure. Thank you. I have 2 questions if they can be addressed. The first would be, given that the team has mentioned that they're seeing some green shoots in base orders, and if tariff settlement is near, do you expect pick-up in the investment cycle or broad-based pick-up in large order finalizations, which has been not the case for the last 2 to 3 quarters? So what would be your view on the likely revival or recovery in the capex momentum? And if the momentum is the way it is there today with flattish book and just early teens growth in base orders, would you think it would be possible for ABB to manage double-digit growth in CY26? Or probably that too would be a year of moderation or consolidation like 25. And in case if you can give any comment, NVIDIA, the recent relationship on which NVIDIA and ABB are working together for solid-state drives for AI data centers, in your view, by when you think the product for this market would be available and ready? And in case if that product is available in India for ABB, to what extent it can increase the TAM for us in the DC market? Thank you.
So Sanjeev, I think we could invite Kiran and Sanjeev Arora on this, because they are reading the markets quite stronger for EL and MO or any of 75% of business. So I have Kiran over here. So
Please.
Yeah. Kiran, so you could throw some color from EL and motions, of course, Sanjeev Arora could throw.
Yes. Thank you, Sanjeev and Sridhar. I think it's a good question in terms of the market, how it's behaving, and also a quite an elaborate question in terms of what exactly we are trying to do in data centers as well. I think let me pick up some few of the segments of the market. Let me just pick up something on renewables, rail, and maybe something on data centers since the question is there. Now, when I look at the way renewable sector is behaving, what we see is a good expansion in terms of the renewable market. Specifically when it comes to renewable, I am also looking at something known as battery energy storage systems, which we call it as BESS. So that's something which is really topping on the charts in terms of the opportunities which is available for the future as well. And we are also looking at something on green hydrogen, which is also becoming very prominent as a sector in the market. When I look at rail, you have seen a lot of expansions across investments from the government and also into the metro sectors, metro rail across the various cities of India. So that's something which is an investment which is coming across. And we find that this is going to really contribute to the base orders going forward. On the data centers, when I look at it, I segregate into two parts. One in terms of hyperscale and the second one in terms of the co-location data centers. When I look at hyperscale, yes, there is a bit of a sluggish kind of a movement in India at this point of time, or probably in the Q3, and we are also looking at a bit in terms of a sluggish growth there in hyperscale. But at the same time, what is important to understand is how exactly the co-location data centers are behaving. I think co-location centers, data centers, there's a huge demand for them in terms of the capabilities, what they can extend, and also the preference of the customers, and they want to have co-locations which is really supporting them in their day-to-day processes. So we feel that data centers in co-location would grow, and we have seen that substantial growth in Q3 as well, and we would like to go forward with our services and solutions to them even this quarter as well, and last quarter as well we have been doing the same. So maybe over to Sanjeev Arora.
Yes, thank you, Sridhar. Thank you, Sanjeev, and thanks, Kiran. I think I echo what Kiran has just mentioned. So giving a flavor of the discrete part. Base load orders, as Sridhar has mentioned, they have been very good for us. And that shows the early signs of positivity in the market demand. Because when we compare to last few quarters, yes, there was a challenge. And Kiran has well explained on the segments part. But then when we touch upon the cement and the steel and the oil and gas part, I would say that the investment cycle has started in these segments as well. So cement, we are seeing a bit of a revival and upturn in the investment. Same goes for steel industry. And also we do see a good pipeline in the oil and gas sector. So yes, the markets will be a bit dynamic. Price pressures will be there. But the good part is that demand will also be sustained in the coming quarters as we see now. So that's the comment from my side.
Yeah. Thanks, Sanjeev. Thanks, Kiran. So, Renu, I think hopefully this gives you a more granular view than at the company level. So, because that leaves only process automation and robotics. So, process automation forms only 13%, and we alluded, and that's some of the comments which Kiran and Sanjeev have given also applies to them in a way. So, I think overall we feel that when the market would be at similar levels as what we see at this point of time, the next 1 or 2 quarters. And then probably we could see some thing which could be on the positive side as what is the assumption at this point of time.
Got it. Anything on the NVIDIA opportunity or TAM for India?
Yeah, so I think that question is reserved for Sanjeev. So Sanjeev, on a larger scale, you could probably give some color on that.
Could you repeat the question, please?
The engagement of ABB with NVIDIA.
For solid state cooling solutions. The recent engagement with ABB parent with NVIDIA for AI data centers to develop solid state drives and cooling solutions. In your view, can the solutions be available to ABB in India when the products are prepared and ready? And to what extent it can increase our TAM in this particular segment?
So at this point of time, I don't have the complete details of this particular deal. I know as much as you know in terms of intent of ABB expressed with NVIDIA. But as a principle, if there is no geographical restrictions of application of those technologies, all technologies ABB develops, they are naturally available to our customers here in India.
Got it. Thanks much, team. Thank you.
Thank you, Renu.
Thank you. A reminder to all the participants, please restrict yourself to one question. The next question comes from the line of Atul Tiwari with JP Morgan. Please go ahead.
Yeah, sir, thanks a lot. Sir, my question is on this QCO. Could you elaborate a little more on, what exactly is the nature of this QCO order, which is leading to higher imports, and how long this impact will continue before you adjust to the QCO fully?
So, Atul, I have actually in my commentary elaborated quite a bit, including what's the impact on QCO, right? So, for the benefit of again, I think people joined in late or missed out what I said. I think what is QCO? The government, in its mission for Atmanirbhar, this thing has wanted to create an system where Indian manufactured or developed products are more used. And before they use, I think they had to be tested and qualified by the Indian Bureau of Indian Standards, and that's something which is getting done. So now in that, till now it was not mandatory, but now it has been made mandatory. So therefore all the products have to be, whatever we manufacture including the subcomponents, have to go through the testing and certification of these particular institutes. And it takes a lot of time because the number of labs are less, the number of slots are less, and there are so many people competing for the same slots. And therefore it is definitely a problem. So probably I think, and that's exactly why the government also keeps extending these particular deadlines, because they know that there is an a capacity issue which they have to address, right? So but now, on the other hand, having come to know that this is a problem on hand, so we need to draw a decision which is better in terms of serving the customers. So we have no other option if we want to keep the customer serviceability as a main criteria to use imported material to make sure that which are already certified by the global laboratories that which could be used, right? So that's something is what is QCO about and how are we handling that. So to address this, because there is going to be definitely a lot of time which will be taken to get our products certified and so forth, the others as well. And therefore, in the interim, we have no other option but to import material to serve our commitments to the customers. So what does this mean? What used to be locally developed and which we are using at a cheaper cost, which we now need to import, for the base cost itself increases, number one. Number two is that you have a forex which is attached to this particular transaction, so that's also subject to volatility. So you have an impact on both. So how long will it continue? It could continue, as what I said, to another 3 to 4 quarters is what I mentioned.
Okay, sir. So very perversely, this order, which was designed to promote Indian manufactured equipment, is leading to higher imports. That is so that's what I wanted to understand. So as an industry, are you guys not representing the government that it is serving the opposite purpose of whatever was intended?
So you think that we will not do it, Atul? So we have done through a lot of other associations. Every industry is making sure that it is representing itself to the right authorities to do it. But I think it's a government objective. It's good.
Atul, you can also help us by writing an analyst report and publish it in the major media. And Soini can help you with all the information. If any help that we can get to get this thing through is always good. But it's a matter of time. It will be sorted, but yes, that's the stage we are right now.
We need to go through it, Atul. We have no other way. Okay.
Yeah. Thank you, sir. Thanks.
But it's good in the overall interest of the nation in the long run. That's how we look at it. Okay.
Okay. Thank you.
Thank you.
Thank you. Next question comes from the line of Lavina Quadros with Jefferies. Please go ahead.
Hi, sir. Thank you for the opportunity. Just wanted to check, sir, on the robotics arm. I'm sorry if I missed if it was discussed earlier, but on the robotics arm, given the parent has sold it at a valuation, earlier there was a thought that maybe the robotics arms gets listed separately. I mean, how are the Indian shareholders going to get compensated for it? Just to understand, will the arm be separated out, or will the valuation be in line with what is being offered to the parent? Thank you.
Sanjeev, you would like to answer that? Because
sure. So we had made it clear at a global level that the robotics business will find its own footing, so that they can find their growth path in future. And then initial interest was to list that company, but then we had in the interest of the shareholders, we got a very good offer from SoftBank, and global board decided to choose SoftBank to be the future owner and take this business forward. As far as India assets are concerned, these assets will be evaluated by the board, independent directors included, and we will follow the due process of evaluating it. And after the valuations are done, like we have done in the past, and the local board is satisfied, based on that valuation, separation of this asset will be done into a new company. But then this is something is not given. This is subject for ABB India Limited board approval. Yeah.
Understood, sir. So, sir, just lastly on this only, so listing is unlikely, but a separate valuation will be decided, and then you'll follow the due course process. Broadly, at least as of now, that's what seems to be the case.
Absolutely.
Great. Thank you.
Absolutely. So that's how these assets are dealt with. And if you see the history of similar assets separated from ABB India Limited, we follow a very tight governance model, and that is led by the ABB India Limited board.
Thank you.
Thank you. Next question comes from the line of Samir Thakur with Ambit Capital. Please go ahead.
Yeah, hi, thanks. So you said that the pipeline for energy industries and process industries, that is still there. And is this just a problem of conversion to orders? And are you seeing that pipeline is increasing, or is there an underlying issue with the demand or any loss of market share there?
Sanjeev, you like to
this question is it for a specific market segment?
No, I think it's for process industries in general, process automation. Which is
process automation.
Oil and gas, cement, steel, and other core sectors. Balaji is not there.
From process automation?
Balaji is not there on the call. I think he's with the customer.
So as such, if you really look into the focus of ABB into the process industries, we have very distinct focus on market segments like oil and gas, we have mining, we have cement, we have pulp and paper, metals. So these are the market segments which we participate with their capex cycle as well as their opex cycle. And capex cycle is sometimes the greenfield project, and sometimes it is the expansion of the project, and also sometimes they have the upgrade of their digital infrastructure, energy efficiency infrastructure. So we find that these sectors, given they are the continuous industries, they continue to invest in all the cycles. It is the intensity changes only when the greenfield projects are announced or major expansions are announced by these players who are operating in this market. So our typical drumbeat and our rhythm is around OPEX as well as the expansion in the normal course of the business, and that we see is quite robust at this point of time. And that continues to be robust because these are substantial industries. They have to continue to invest into the area we are. Now, when it comes to the major expansion, the greenfield expansions, in certain market segments, we definitely see there is a greenfield expansion, but it is not widespread. And I believe the cycle of the demand versus how much capacity is available, there is likely to be a upsurge in the capacity utilization of capacity expansion of many of these segments. At the same time, one has to also keep in mind, this is something which I cannot say as a confirmation, but in the news media there is a clear mention that between India and China now there is a thaw of relationship and more businesses are opening up. So it is unclear what will be the impact of Chinese imports in the country. So I think all our customers who are in these process industry segment, they will be also evaluating very closely how this will play out, whether the Chinese imports will flow into the market in an uncontrolled way, whether that will impact their price realization in the market. So I think that part is unclear at the moment, and that will define the future demand curve of these industries, in our opinion.
Yeah, okay, thanks. If I squeeze in one more, just coming back to again QCO1, there was a deadline in November 25 as well for some of the products. So I was just wanted to check if I understand clearly that imports, the QC related imports, that we'll keep on doing. Is that the right way to think of? We had earlier imported in, I think, March, April, May, in that quarter. And probably going ahead, we have to keep importing unless we build the certifications.
Yeah, so what happens is this, the government keeps moving these particular dates, right? So what has come in, what we thought as we were working in the second quarter, that November is the date before which we have to close this, and in case if we don't do it, so then you have to definitely use the imported subcomponents what we require, right? So, but we go with that anticipation, and we try our best to get it qualified in the laboratories, right? But in case if we see that there is a delay, we have no other option but to make sure that we have to import more for the future requirements. But then the government, as we near to this thing, so the government takes a call to extend it. So this is basically, that's exactly what I said. So now the government keeps moving these deadlines depending upon how the progress is and how they are able to monitor this particular process. So we need to go with that and be in line with the process for certification. So I think that's a bit of there is no a definite saying that it will close at this date come what may. It's not going to happen because as I mentioned earlier, the capacity is less versus the work to be done, which is humongous, right? So that's taking more time, and therefore we have to go along with what the government is directing us to do.
Okay, thanks. That's it from my side.
Thank you.
Thank you. A reminder to all the participants, please restrict yourself to one question. Next question comes from the line of Amit Mahawar with UBS. Please go ahead.
Morning, Sanjeev and Sridhar. Congratulations on maintaining a very good order momentum in base orders, better than industry maybe. Sir, I just have one question. You have the book in process automation, which is maybe around 30-40% down. EP is the only segment where we've grown very well, 15% in top line, and I don't worry about margins. It's a transitory issue. But do you think in CY26 we can touch a 10-12% revenue growth, given that mobility orders will take some time, given that energy is not a large basket for us, and the discrete portfolio for us is growing more in just short of teens or less than that. So a qualitative assessment, Sanjeev, which will help us. Thank you.
I think it's fair to say, as process automation is concerned, net of robotics, it will be only 13% of our portfolio, 12 to 13% of our portfolio. So we take benefit of industry cycle whenever there are large capex projects and the large consolidated orders coming to us or system orders coming to us. Other than that, we continue to gain on the ETO, which is engineer to order business, which is largely sitting in MO and EL, so that continue to benefit. And then, of course, we have the EL business, which is the product business, which is made to store and made to order, fast-moving products in the marketplace. So in the made to order, made to store, and ETO, I think the business is quite robust, and we do feel that, given the backlog that we have, the execution of it is well lined up. They're clean orders, so we will see an uptick of revenue growth with that as we go forward, both